Hello, hello. We are taking a look at Group 1 Automotive, which is a company that was suggested by one of our subscribers and members of our Discord channel. I thought it would be a little bit interesting to take a look at this one because it's an industry that we don't really tackle too much. It's the auto and truck dealership one. Now, this is a consumer cyclical one because car sales are a pretty cyclical thing. They can go down, especially when the market is in a downturn. And so, right now, this may be a little bit of a riskier one, but we need to examine what kind of financials they are having because that's obviously very, very important. Now, in case you don't know exactly what this one is, you can take a look at our company profile page. Of course, you can have access to all this by becoming a Patreon. Links in the description box below this video. And you will see that through its subsidiaries, it operates in the automotive retail industry, sells new and used cars, light trucks, and vehicle parts, insurance contracts, and things of that sort. So the thing is, when we're talking about new cars, they obviously have better margins than used cars. Yet it's much tougher to sell new cars in an economy that goes down. So typically, this company will probably be making more of a higher part of its revenue from selling used cars than new cars right now. As we're entering it, we are facing the economy where we could be having a recessionary downturn, or at least a temporary downturn for a little bit while. Now the company's beta is 1.4, so this actually moves more than I would expect, frankly, being this kind of company. But let's take a look at our metrics page. Let's see how much it has been moving and what has been happening. The 1 year chart is almost like a choppy thing going up and down quite significantly. Now we're in the down range, which I like to see. I like to see a lot, obviously. And it seems to be trading at near 140 to 200 pretty much. It's again trading at a range. The 3 years chart is a little bit different because we had a massive increase over here. And if we take it 5 years, you will see it even better. Over here, it had a massive downturn and then it started climbing. The max chart is even more telling here because you will see that the company has been having obviously its typical cyclical upturns and downturns. You'll see it a lot over here. Then it had a massive downturn and then an upturn over here, and then it starts kind of going down a little bit. Now, I don't like this fact that it has been coming up so much, frankly. And right now it's basically sitting at a new range. That doesn't mean that it will that it's a bad buy necessarily in terms of its fundamentals, of course. But it's something that you do have to note here. The fact that the company has been pretty much trading at much lower prices a few years back, and right now it's entering a different range. It looks like. Okay, so the thing is, the P ratio and price to free cash flow ratio are still very low, and they're getting lower. So this is something that I love to see, obviously. Now the price to free cash flow is even lower here. At some point, it was even negative. So it's actually getting at lower territory here, with the company buying back shares, quite some of those, because obviously the company seems to be at a nice at a nice valuation here, and this is why they have been buying back shares. Now they are growing still, quite some over here. Again, this is not a company that will be having massive growth. It's a car dealership, pretty much, a company that's selling cars. And so this is not gonna be growing a ton. It's like 20% in the last 5 years. Net income growth has been growing though, so they have been getting more and more profitable. And free cash flow growth has also been growing a ton recently, in the past couple of years or so, with the total equity also growing despite the fact that they have been buying back shares, which is another nice thing to see. And they don't have too many liabilities compared to the free cash flow that they generate, yet their debt is potentially quite high compared to their equity over here. Something probably to be expected again from a company that's actually buying and selling cars. That would make a ton of sense here. And their return on equity will be high because they have this extra debt too. This will help. Company is also paying a little bit of a dividend here, like 1%, which is a very low percentage of their free cash flow or net income. And so it's very easy for them to be paying that out. But let's take a quick look at their dividend, and you will see that it has been increasing as well. So it's nice to be pocketing a little bit of a allowance over here, like a 1%. Not bad at all. Why not? Okay, so in terms of the financial statements of the company, what are we having? 11 billion to 13.4. So normal increase, not bad at all. About 20% is what we examined. In terms of net income, 200 million to 500, so doubling net income over the years. Again, pretty nice to see, not bad at all. And in terms of their balance sheet, it's interesting to see that the company's total equity has been increasing, even though they have been obviously spending money to basically buy back shares, because they have been pretty much buying back their shares, creating treasury stock. And if you are a holder of the company, your stock is worth more. So that's nice to see for a stockholder and potentially new shareholders as well. Now the company has about, where is it, the total liabilities over here has about 4 billion in total liabilities. And if we take it to our cash flow statement, you will see that they are making about 1.1 billion, which is a lot compared to the total liabilities that they have. They can very, very easily repay all the total liabilities. Nice to see for the company. And the dividends that they are paying are very little, as you'll see, a very, very small percentage of their free cash flow, no problem at all. They could very, very easily increase their dividends by quite some and still be very fine over here. So that's very nice. In terms of the net income, again, converting to operating cash flow. Another nice thing to see, 200 million to 1.2 billion over here. Very nice increase of their operating cash flow without much trickery going on over here. Some changes in working capital will happen though, and inventory changes as well. Something that's also very, very important and that can really, really affect the operating cash flow here. So that's something to note, especially the changes in working capital have to do with the changes in current liabilities and current assets, frankly, and can really, really affect the operating cash flow over here. And you will see that this has been affected in the last couple of years by that. So it may be worthwhile to see exactly what's going on here in terms of inventory and change in working capital, because in the previous this was lower. And if we take it back there, they were making about 180 million in terms of free cash flow here. So this is a pretty steep difference here, the change in working capital and inventory, and it may be worthwhile to examine the finer details. So let's take a little bit of a closer look at that. As always, we can use our tool here to have a little handy and very quick way to actually discover the financial filings here for the company, the SEC filings. And I have opened up the latest 10K for the company. I have it over here. You can just click basically on our tool and open it up. So it will take you to this tab. And I have already gone to the consolidated statements of cash flows because that's what we care about. And I kind of want you to see what caused the difference, the big difference in the operating cash flow through the last couple of years or so. And if you take a look at the numbers here, you can very, very quickly see that the biggest difference is actually inventories. So you will see here that these are positive numbers. So what does that mean? This basically means that we sold inventory, and by selling inventory, we got some money, some cash, obviously. So we got rid of inventory, getting extra cash. If we actually bought inventory, that would be a negative value because we have spent cash flow, as you can understand. And if you go back to our tool, you can also see that in our financial statements balance sheet, you can kind of see what we're talking about. The inventory levels have been going down in the past couple of years. So you can kind of see it here clearly that the balance sheet reflects that. It's not going to be the exact numbers. They are never the exact numbers. That has to do with accounting. You will never be able to actually exactly see the numbers that you're seeing in the cash flow on the balance sheet. They will never match. So again, this is because the company sold a lot of inventory, and that's good. Obviously, this is a strong cash position for the company. They're making more by selling more, so that's something that you like to see. And this is what caused the big increase here in the operating activities cash flow, or in the cash flow of the company. It's nice to see. You do want to know where this comes from, and in this case, it looks like it's obviously a pretty good thing. Okay, overall, I think this one is an interesting company to potentially hold, but again, remember there is some risk in the sense that people may stop buying cars for a little while, especially if we are reaching a recessionary environment. Now, the fact that they are selling some used ones, it may be good because they can still keep generating revenue, but it will likely affect their margins if it hasn't affected them yet. Actually, probably not yet, but it could actually drop them in the upcoming years or so. I don't know. This is a little bit sketchy over here in terms of that. Again, because of the environment, this is a deeply cyclical sector, as you can understand, and so you have to be extra careful. However, the fact that the company has been able to easily sell their inventories, they are doing well with their growth over here, pretty much everywhere. They are buying back shares, so there are nice things to see. And even though the stock is actually high in terms of its technicals, as you may have seen before, the fact that it has been at a range and now it's at a higher range, maybe a little bit of an issue here as well. But overall, in terms of its fundamentals and a long-term buy, this could this could be a nice buy. Again, with the risk that the whole economy could crumble for a while, and then this could at least trade at a range or even lower than where it is right now. But there are some nice things here for sure. So it is a company that it may be worthwhile considering, but again, take it with a grain of salt because it can actually give you some headaches in the future potentially. Again, as we're entering a recessionary environment potentially. Now, our stock evaluation tool is going to give us the last picture pretty much. And you will see that the average growth of the company has been at about 4%. Now I'm going to go lower here, much lower. I will go 0%, 0, 1, and 2. And for net income margins, I'm going to be 2, 3, and 4. And free cash flow margins, I'm going to go 90, 100, and 110 because they typically do more than 100, frankly. In terms of annual return, 13%. And I'm pretty sure we're going to get green everywhere over here and pretty comfortably, as expected, of course. And this has a lot to do with the current valuation and the industry. And the fact that you are seeing 500, don't salivate, because this has a lot to do with the free cash flow that the company generates, and you do have the extra risks of the industry. So while this looks like it's a green, and it may in fact be a green and a solid buy, you could have some low term, some short term risks in this one. Because remember, not every industry is the same, and some industries will have inherently smaller PEs and smaller price to free cash flow ratios as well. However, yeah, this is a company that could be an interesting purchase for a long-term environment, a long-term portfolio, and you may potentially like set it and forget it even. So yeah, think about it and let me know what you think about this company with a comment below. And thank you for watching this one. Remember to leave a like and subscribe, and I'll see you soon. Bye bye.